Payday loans are short-term, small-dollar loans typically used by individuals who need quick access to money to cover unexpected expenses or bridge the gap until their next paycheck. A lot of people get screwed over by payday loans because they probably don't fully understand how they work or the better alternatives that exist. In this video I'll be teaching you these things and how they could ruin you. Welcome back to my channel. If you are new here, please consider leaving a like and subscribing to the channel. I make videos teaching you how to achieve financial freedom. Alright, then let's jump right into today's video. To illustrate how payday loans work, let's walk through this example. Sarah is facing a financial emergency. Her car broke down, and she needs $500 to get it repaired. She doesn't have enough savings to cover the cost, and her next paycheck is a week away. Sarah decides to apply for a payday loan. She searches for local payday lenders or applies online. Sarah provides the lender with her personal information, proof of employment and income, such as pay stubs, and a post-dated check for $500, dated for her next payday. She also pays an initial fee, which might be, for example, $15 for every $100 borrowed. The lender reviews Sarah's information and approves her loan application. She receives $500 in cash, or it might be deposited directly into her bank account, depending on the lender's practices. Sarah is required to repay the loan on her next payday, which is 1 week away in this case. The lender will cash the post-dated check or electronically withdraw the amount, including fees and interest. If the total fee for the loan is $75, which is 15% of the $500 loan amount, Sarah will owe $575. If Sarah is unable to repay the loan in full on her next payday, she may have several options. She can ask the lender for an extension or rollover, but this typically comes with additional fees and interest. Some borrowers take out a new payday loan to repay the existing one, leading to a cycle of debt. If Sarah doesn't pay or make arrangements with the lender may initiate collection actions, including reporting her to credit agencies or pursuing legal action. It's important to note that payday loans can become very costly due to their high interest rates and fees. In this example, a $500 loan with a $75 fee for a 1-week term results in an APR of approximately 391%. This high cost is a significant drawback of payday loans, and borrowers can quickly find themselves trapped in a cycle of debt if they cannot repay the loan in full by the due date. Because of these risks, it's essential to carefully consider alternative options and seek financial advice if facing a financial crisis. Let's look at the features so that you'll be able to recognize them. Payday loans are typically for relatively small amounts, usually ranging from a few $100s to a few $1,000s. They are intended to be repaid within a short period, typically 2 weeks to a month, or on the borrower's next payday. Payday loans are characterized by high interest rates. They often come with very high annual percentage rates, making them an expensive form of borrowing. The APR can sometimes exceed 400%, depending on local regulations and the lender. Payday loans are relatively easy to obtain, with minimal credit checks or requirements compared to traditional loans. Borrowers typically need to provide proof of income, a bank account, and identification. Payday loans have post-dated check or automatic withdrawal. To secure the loan, borrowers may need to provide the lender with a post-dated check or authorize an automatic withdrawal from their bank account for the full loan amount, plus fees and interest. You also have to be aware of the rollover and renewal. If a borrower is unable to repay the loan by the due date, they may be allowed to roll it over by paying additional fees. This can lead to a cycle of debt, as the borrower continues to owe more money without making a significant dent in the original loan. I wouldn't suggest you to use them. It's better to look for other more reliable alternatives. These types of loans have so many disadvantages that heavily outweigh the benefits. These guys often employ some very aggressive collection practices. A number of them make sure to get their money using all means available. Some of these tactics include things like continuous withdrawal attempts from the borrower's bank account, which can lead to overdraft fees and other financial problems. They also typically have very high annual percentage rates, which makes them quite an expensive form of borrowing, and borrowers can end up paying significantly more than they initially borrowed. The short-term nature of payday loans means that borrowers must repay the full amount, including fees and interest, within a few weeks. This can be challenging, especially for individuals living paycheck to paycheck. This can actually keep you in constant poverty and in a cycle of debt if you keep using these loans. And speaking of debt cycle, many borrowers who cannot repay their payday loans in full on the due date end up rolling over the loan, which incurs additional fees and interest. This cycle of debt can be difficult to break, leading to a worsening financial situation. Also, if a borrower defaults on a payday loan, it may be reported to credit bureaus, damaging their credit score and making it more challenging to access affordable credit in the future. In some areas, payday lenders are subject to minimal regulation, which can lead to predatory lending practices and a lack of consumer protection. Let's now try and look at the alternatives to this type of loans. First, you need to actually create a safety net for yourself by developing an emergency fund. Many people go to payday loans to help solve an emergency they didn't plan for, which ends up ruining them financially. If they would have had some money saved up, they probably wouldn't have had to do this. Building an emergency fund is one of the best ways to handle unexpected expenses without resorting to payday loans. Having savings can provide a financial safety net in times of need. Borrowers with good credit can consider personal loans from banks, credit unions, or online lenders. These loans typically have lower interest rates and longer repayment terms compared to payday loans. If you have a credit card, it can be a more affordable option for covering unexpected expenses. Be sure to pay off the balance as soon as possible to avoid high interest charges. You could also consider negotiating with creditors. If you're facing financial hardship, reach out to your creditors to discuss payment options. They may be willing to work with you to create a repayment plan. Also, some nonprofit organizations and charities provide financial assistance to individuals in need. They may offer grants, low-interest loans, or other forms of support. Depending on your situation, you may be eligible for government assistance programs that can provide financial aid for specific needs, such as housing, food, or healthcare. Consider borrowing from peer-to-peer lending platforms, where individuals lend money to one another at potentially lower interest rates than traditional payday lenders. Explore opportunities for part-time work or gig economy jobs to supplement your income and cover unexpected expenses. If you're struggling with debt, credit counseling agencies can help you create a budget and work out a plan to manage your financial situation. It's important to explore these alternatives before turning to payday loans. They offer more affordable and less risky ways to manage financial emergencies and avoid the pitfalls associated with payday lending. Payday loans have been criticized for their high costs and potential to trap borrowers in a cycle of debt. Many governments and consumer protection agencies have implemented regulations and restrictions on payday lending to mitigate these risks and protect consumers. Some alternatives to payday loans include personal loans, credit unions, and seeking financial assistance from family or friends, as they often offer more favorable terms and lower interest rates. I hope you enjoyed the video. Don't forget to hit that like button if you find this video helpful, and if you have any questions or suggestions, also leave them in the comments section below.